Burns McKinney, MetLife is a company that's relying on international growth to really fuel its business. Will they be able to get it?
Yeah, we feel pretty positive about it. We own MetLife in our NFJ Dividend Value Fund, which has a real focus on low PE dividend-paying stocks. And one of the positives about MetLife was that during the financial crisis, when everyone else was having to retrench, they had the opportunity to go out and buy AIG's foreign life unit, which got them to really a leg into places like China and Brazil. Now, obviously, there's some concerns about what's going on in the emerging markets right now, but for investors like us that have a 3 to 5 year time horizon, then there's really some very positive growth opportunities for a company like MetLife there.
And you're also a fan of Norfolk Southern. Now, they're transporting a lot of oil via the railways. What's going to happen when we actually start approving some of these pipelines like the Keystone? Will that take away some of their oil business?
Yeah, you hit the nail on the head for exactly why we can afford to buy Norfolk at a 2 or 3 multiple point discount to the rest of the rails. They do have that exposure. They also have a lot of exposure to coal as well within the energy space. And I think that one of the issues with the coal business is that with coal plants being taken offline, that's driven the stock down, and investors have really gotten away from the fact that the intermodal business, whereby with lengthening global supply chains, is really as strong as it's ever been. And again, for a company that they just raised their dividend by about 4 or 5% last year, we love seeing that confidence in the business.
And then finally, you're a fan of Baxter. Now, this has really underperformed the rest of the healthcare stocks, which have done so well over the past 2 or 3 years. This one has been a serial underperformer, not just the other healthcare stocks, but the S&P as well. Why do you want to get in now? You think it's going to turn around? Prove?
Yeah. It's a perfect contrarian stock for what we do at NFJ. As a result of some of the recently lagging, you can get into Baxter right now for about 13 times earnings. The rest of the medical device peers are about 15 times earnings. They have a highest dividend yield in the industry at about 3%. And likewise, again, just like I spoke about Norfolk Southern, that's a dividend that's been going up. They've been raising that dividend by double-digit rates per year over the last 5 years. And really, what they do is they produce non-discretionary consumables for people who have chronic diseases, for things like cancer and kidney disease, and things like IV solutions that people can't live without, which it really makes their revenues repeatable, recurring, more predictable, and as well, I think one of the keys is it makes them a little bit less susceptible to any sort of healthcare rationing that might take place.
All right, thanks a lot, Burns.
Thank you so much. It's a pleasure.
Thank you for watching The Street.